Well, it's finally happened. After watching dividend investors quit left and right over the past year, chasing meme stocks and crypto promises, I've discovered the three brutal obstacles that are secretly crushing dividend investing portfolios, and why the investors who understand these challenges are actually positioning themselves to retire early while everyone else gets distracted by the next shiny object. So if you've been building a dividend portfolio, or you're thinking about starting one, you've probably felt the frustration. Maybe you're collecting a few dollars each month while watching your neighbor brag about his latest Nvidia stock gains. Or maybe you've questioned whether this slow and steady approach actually works when everyone around you seems to be getting rich faster. But here's what most people don't realize. The very obstacles that drive 87% of dividend investors to quit are actually creating the biggest opportunity for passive income we've seen in decades. And by the end of this video, you'll understand exactly how to navigate these challenges and why Michael Burry, Warren Buffett, and other legendary investors keep coming back to dividend strategies even when the market goes crazy. So let me start with some data that might surprise you. According to a recent study, the average dividend investor holds their positions for less than 18 months before switching strategies. That's barely enough time to see 2 dividend payments from a quarterly paying stock. Compare that to Warren Buffett, who has held Coca-Cola for over 30 years and now receives more in annual dividends from that single position than his original investment. But why do so many people quit? Well, after analyzing hundreds of dividend portfolios and talking to investors who've both succeeded and failed with this strategy, I've identified 3 core obstacles that separate the winners from the quitters. And if you can understand and navigate these obstacles, you'll have a massive advantage over the 90% of investors who give up. So the first obstacle is what I call the psychological torture of slow progress. And this one is brutal because it attacks your motivation at the exact moment when you should be most excited about your strategy. Here's how it works. You start with $100 a month, buying shares of a solid dividend stock yielding 4%. After your first month, you receive 33 cents in dividends. The next month, maybe 67 cents. By month 6, you're looking at maybe $2 in monthly passive income, and you're thinking, at this rate, I'll be 150 years old before I can retire. And this is exactly when the market starts tempting you. You see GameStop shoot up 400% in a week. You watch someone on TikTok turn $1,000 into $50,000 trading options. Your dividend portfolio, meanwhile, is chugging along at what feels like the speed of molasses. But here's the data that changes everything. According to FINRA, 80% of day traders lose money within their first year. That GameStop rally? Most retail investors actually lost money because they bought near the peak and sold at the bottom. The TikTok millionaire? Probably lost it all on the next trade and just didn't post that video. So let me show you the real math that these quitters never stick around to see. This is a chart showing how a $300 monthly investment in dividend stocks actually grows over time. Year 1. $72 in annual dividends. Pretty pathetic, right? But look at year 10. $2,847 in annual dividends. Year 20. $12,156 in annual dividends. And by year 30, you're looking at over $30,000 in annual passive income from a strategy that most people abandon in year 1. This is what I call the dividend snowball effect, and it's backed by decades of data. The S&P 500's dividend aristocrats, companies that have increased their dividends for 25 plus consecutive years, have outperformed the broader market by an average of 1.2% annually over the past 30 years. So how do you survive the psychological torture of slow progress? You need what I call future vision, a system that shows you exactly where your dividends are headed, not just where they are today. This is why I recommend every serious dividend investor use a tracking platform like trackyourdividends.com. It's free, and I'm not sponsored by them, but here's why it's crucial. It shows you projections of your future dividend income from the best dividend stocks based on your current contributions and historical dividend growth rates. When you can see that your current $3 monthly dividend income is projected to become $150 monthly in 10 years, suddenly that slow progress doesn't feel so discouraging. You start to understand that you're not behind. You're exactly where you need to be. Now, the second obstacle is what I call the isolation factor. And this one is particularly dangerous because it's not about your portfolio performance. It's about your psychology. Here's the situation. You're at a dinner party, and everyone's talking about their latest stock picks. Someone made 40% on Palantir. Another person is bragging about their crypto gains. Then someone asks about your investments, and you say, well, I own Enterprise Product Partners and Realty Income Corporation for the dividends. The conversation dies. No one knows what you're talking about. And this isn't just social awkwardness. It's a real psychological barrier. When you're surrounded by people chasing growth stocks and crypto, dividend investing can feel outdated, boring, even foolish. You start questioning whether you're missing out on the real opportunities. But here's what's actually happening. You're witnessing survivorship bias in real time. The people bragging about their Tesla gains aren't telling you about their losses on other trades. The crypto millionaire isn't mentioning the 60% drawdown they experienced last year. So let me give you some data that'll make you feel a lot better about being the boring investor in the room. Over the past 50 years, dividends have accounted for approximately 40% of total stock market returns. That means when someone brags about their S&P 500 gains, nearly half of those gains came from dividends being reinvested. And here's another fact that might surprise you. During the 2008 financial crisis, when the S&P 500 dropped 37%, the dividend aristocrats dropped only 22%. During the 2020 COVID crash, the same pattern held. Dividend stocks don't just provide income, they provide stability when the market goes crazy. So how do you solve the isolation factor? You need to find your tribe. And this is easier than you might think. There are thriving dividend communities on Reddit, like r/dividends. Seeking Alpha has an active dividend section, and even here on YouTube, the comment sections under dividend videos are filled with like-minded investors sharing their strategies. But more importantly, you need to understand that being the boring investor in the room often means you're the smartest investor in the room. Warren Buffett has been called boring for decades, and his shareholders don't seem to mind. The third obstacle is what I call tax terror. The fear that dividend investing will create a massive tax burden that eats up all your returns. And I'll be honest, this one stops more people from starting dividend investing than probably any other factor. Here's how the fear typically goes. If I buy dividend stocks, I'll have to pay taxes on every dividend payment, even if I reinvest it. That's going to kill my returns compared to just buying growth stocks and selling them later for capital gains. But let me show you the actual data on dividend taxation, because the reality is much less scary than the fear. First, if you're investing through a Roth IRA, dividend taxes are completely eliminated. Zero taxes, ever, on your dividend income, as long as you follow the withdrawal rules. Second, if you're investing in a regular taxable account, most dividend payments from established companies qualify for qualified dividend tax treatment, which means they're taxed at the same rate as long-term capital gains, not as ordinary income. For most investors, that's either 0%, 15%, or 20%, depending on your income bracket. So let's do the actual math on taxes versus returns. Say you're in the 15% qualified dividend tax bracket, and you receive $1,000 in dividend income. You'll pay $150 in taxes, keeping $850. But here's what most people miss. That $850 is money you can spend or reinvest immediately, without having to sell any shares. Compare that to a growth stock that appreciates from $10,000 to $11,000. Sure, you don't pay taxes until you sell, but when you do sell to access that $1,000 gain, you'll still pay capital gains taxes. And more importantly, you've just reduced your position size, which means less future growth potential. Here's my perspective on dividend taxes, and this might be controversial. Complaining about paying taxes on dividend income is like complaining about paying taxes on a salary increase. Yes, you pay taxes, but you're getting more money. I've never met anyone who turned down a promotion because they'd have to pay more taxes. If you're really concerned about taxes, focus on maximizing your IRA contributions first. But don't let tax fears prevent you from building an additional income stream. The goal isn't to avoid all taxes. It's to build wealth efficiently. Now let me give you a specific action plan for turning these three obstacles into competitive advantages. Step 1. Build your dividend dashboard. First, set up your dividend tracking system today. Go to trackyourdividends.com or a similar platform and input your current holdings and monthly contribution plan. The key is to focus on the projected future income, not just the current payments. This will help you maintain motivation during the slow early phases. Step 2. Document your progress. Keep a simple spreadsheet or note in your phone tracking your monthly dividend income. Watch that number grow each month, even if it's just by a few cents. This creates positive reinforcement that helps you stick with the strategy. Step 3. Optimize your tax strategy. Max out your IRA contributions first, focusing on dividend stocks within those tax-advantaged accounts. For your taxable accounts, focus on high-yield dividend stocks that pay qualified dividends to minimize tax impact. Step 4. Find your community. Join at least one online dividend investing community. The psychological support of connecting with other investors sharing insights about the best dividend stocks and following the same strategy is invaluable for long-term success. The bottom line. Why patient money wins. Here's the bottom line. Every obstacle that drives other investors away from dividend investing is actually creating more opportunity for those of us who understand the strategy. While others chase the next meme stock, we're building portfolios of the best dividend stocks that pay us increasing amounts of cash every quarter. And the data backs this up. Over the past 20 years, dividend-focused strategies have provided more consistent returns with lower volatility than growth-chasing approaches. You might not get rich overnight, but you also won't go broke overnight. The investors who understand these three obstacles, and more importantly, how to navigate them, are quietly building retirement portfolios while everyone else is gambling on the next big thing. And in 10, 20, or 30 years, when they're living off their dividend income, they won't regret choosing patience over speculation. So whether you're just starting out or you're already building your dividend portfolio, remember, the obstacles that discourage others are creating opportunities for you. Stay focused, stay patient, and let compound interest do the heavy lifting.